We're living in a time where everyone's an investor. Apps make it easy. Social media is buzzing with stock tips. It feels like everyone's getting rich quick. But hold on a second. Before you throw your hard-earned money into the market, let's talk about something they don't always tell you. The market can go down. In fact, sometimes it can crash hard. Remember Japan. Back in the 1980s, their stock market was on fire. Everyone thought it would never end. But guess what? It did. And it's never fully recovered. This isn't ancient history, folks. It's a stark reminder that what goes up can come crashing down. We need to learn from the past, especially if you're new to this investing game. Don't get caught up in the hype. Take a deep breath and listen up. Your financial future might depend on it. Let's rewind to the 1980s. Japan was an economic powerhouse. Their stock market, the Nikkei, was soaring. Real estate prices were through the roof. People were making fortunes overnight. It felt like a party that would never end. But then came 1990. The bubble burst. The Nikkei crashed. Real estate prices plummeted. What followed were decades of economic stagnation. Japan's economy never fully recovered. Why am I telling you this? Because it's a stark reminder that even the strongest economies can experience devastating market crashes. And yet what happened in Japan can happen anywhere. Don't fool yourself into thinking it can't happen again. Japan wasn't a one-off. History is littered with market bubbles and crashes. Remember the Dutch Tulip Mania in the 1600s? People were trading their houses for tulip bulbs. Then the bubble burst, and people lost everything. Fast forward to the late 1990s. The dot-com bubble had everyone investing in anything with .com in its name. Sound familiar? Then the bubble burst, and countless tech companies went bust. And who can forget the 2008 financial crisis? The housing market crashed, dragging down the entire global economy. These are just a few examples of how quickly things can go south in the market. So, what causes these market bubbles? It often starts with something new and exciting, a new technology, a booming industry. Investors get caught up in the hype. They buy, driving prices higher and higher. This creates a feedback loop. The more prices rise, the more people want to buy in, fearing they'll miss out. This pushes prices even higher, further disconnecting them from the underlying value of the assets. But eventually, reality sets in. The fundamentals can't support the inflated prices. The bubble bursts. Investors panic and sell, sending prices plummeting. This is the nature of market cycles. One of the biggest misconceptions about the stock market is that it always goes up. Sure, over the long term, the market tends to trend upwards, but in the short term, it can be incredibly volatile. There will be ups and downs. There will be corrections. There will be crashes. Anyone who tells you different is selling you something. Don't fall for the stocks only go up myth. It's crucial to understand that investing in the stock market involves risk. Section 6, don't be a daredevil. Investing with caution. So how do you navigate this risky business? First and foremost, don't invest money you can't afford to lose. The market can be unpredictable. Don't put yourself in a precarious financial position by chasing quick riches. Second, do your research. Don't just blindly follow the crowd. Understand what you're investing in. Read financial news. Learn about different investment strategies. Knowledge is your best defense against making rash decisions. Section 7, spreading the risk. Diversification 101. Don't put all your eggs in one basket. That's diversification 101. Invest in a mix of assets like stocks, bonds, and real estate. This helps spread your risk. If one investment goes south, the others can cushion the blow. Diversification won't prevent losses, but it can minimize the impact on your overall portfolio. Remember, slow and steady wins the race. Section 8, beyond the hype. Due diligence in the age of information overload. We live in an age of information overload. Everyone's got an opinion, a hot stock tip, a guaranteed path to riches. It's overwhelming. Don't get swept away by the hype. Do your own research. Read company reports. Understand their business model. Look at their financials. Don't just buy into a story. Look at the facts. Section 9. The final word. Investing for the long game. Investing in the stock market can be a powerful tool for building wealth over the long term, but it's not a get-rich-quick scheme. It requires patience, discipline, and a healthy dose of caution. Now, remember the lessons from Japan and other market crashes. Diversify your investments. Do your research. And most importantly, don't panic when the market inevitably takes a downturn. Stay calm, stay informed, and stay invested for the long haul.